Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Warner Brothers Discovery. This was a subscriber request to look at them, so we're going to do a stock analysis on Warner Brothers Discovery. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas of potential stocks to buy or value traps to avoid, or just want some insights on the financials, make sure to subscribe to my channel. And if you do want me to look at a stock, leave it in the comments below, because as you can see, I do a lot of stocks that people ask me basically to look at. So Warner Brothers Discovery, this is a stock that a lot of people are interested in, but it's been doing really bad lately. It's come down significantly. It was basically Warner Brothers and Discovery. They kind of had a merger, but since then they've just been going down, and a lot of these top level metrics don't look good. You can see basically the PE's at a loss right now. It's not very good. Market cap is only $25 billion compared to their enterprise value of $67 billion. And the forward PE is only $33 billion or 33, and they basically are issuing shares right now a little bit through stock-based compensation, and they're not paying a dividend. So is there really any value in this? Are they just really losing all this money, or what's the case? Well, we're going to dive into financials, and I'm going to kind of try to clear things up a little bit, shed a few insights that maybe things aren't as bad as they actually look, but I'm not saying things are that great either. So normally I like to look at the past financials, but that's all completely irrelevant because they recently had basically this merger and they're a completely new company now. So I'm really going to be only looking at the last current year and just kind of showing you what these financials actually mean. So basically, as you can see right now, in the last 12 months, they've done $42 billion of revenue. We have a gross margin of 39%. And right now, the operating margin is negative 3.38. But why is that? Well, it's because you have this large other operating expense. But what is that? Well, this is actually just impairment of basically their different assets they have, like intangible assets, their IP. They've been impairing it since the merger. And this is what's really dragging down the earnings. But just because the earnings are low and negative doesn't actually mean they're losing money, because this isn't real cash exiting, as I'll show you in the free cash flow statement later. Because right now you look at this, you see, look, basically net income almost negative $5 billion. You think, wow, that's not very good, but that isn't the full story of them. Although they do have a very big net interest expense, which that is real money, exiting out at basically $2.2 billion. And even if we kind of factor out basically the impairment charges they've been doing of this $8 billion, and we basically added it in onto that operating income, what would we be looking at there? Under $7 billion. So that interest expense coming off is still quite a large portion of basically any operating income they could potentially be having. So we do know that their balance sheet is a little bit weak right now, and we're going to see if they're going to actually be able to pay off that debt as time goes forward. So right now we take a look at their balance sheet, almost $13 billion in current assets, though they have over $14.5 billion in total current liabilities. So not the greatest current ratio right now, but for basically a larger company like them that has easy access to credit and revolving lines of credits, not too big of a deal, but it's not a lot of strength we're seeing basically out of the get-go. They have total assets of $123 billion, 110 of that being long-term assets, although as you look at all that, almost it's all entirely intangible assets. Basically almost $35 billion of that is goodwills, which is just completely not real at all. It's basically just balances out the books when you do acquisitions, and then the remainder of that, if you take that out, $97 billion is total intangible assets, which includes their various IP. And you can see basically it's been decreasing over the last year. Basically in September 2022, $109 billion, down to $106 billion, down to $103 billion, down to $100 billion, down to $97 billion. So you can see where some of those impairments are coming from, is they're writing down these assets they have, because this is quite a pretty big, significant drop basically in intangibles. Well, I think that almost actually accounts for it all there. So even though basically their total liabilities are only $70 billion, and you see, oh, total stockholder equity of $44 billion. Well, we know that $34 billion of that is goodwill, so there's only really $10 billion of tangible, and that's all basically in intangibles, which is their IP, which they've been writing down. So is there really anything there at all? Well, that's really hard to say, and this is the really big question about Warner Brothers Discovery going on in the future. What is their content actually worth in this whole streaming wars and new phase of all the media, how it's going? How are they going to survive, and are they going to be able to compete? But let's go down a little bit further. Basically, well, before we do that, as you can see, long-term debt. You can see the good thing though, they actually have started paying down the long-term debt. The long-term debt right now is just under $44 billion, but if we look at September 2022, it was over $48 billion. So even though they're showing losses on their income statement, they're still actually able to pay down debt because they do have positive free cash flow. And that's kind of maybe a better way to evaluate Warner Brothers Discovery, but there's also going to be some issues with that, as I'll explain shortly here. So you can basically see cash flow from depreciation, the amortization, and depletion. Basically, these impairment charges very high, and that brings us actually total operating cash flow of $6.7 billion. Although we do for free cash flow, we have to basically take off this purchase of plant, property, and equipment, and we kind of scroll down to get an idea, and you can see free cash flow is almost $5 billion. So if we were looking at that, hey, they had negative $2 of EPS, losing about $5 billion. If we actually look on a free cash flow front, maybe they actually have $2 of positive free cash flow. But this is really going to be hard to say if this is going to be accurate going into the future, because as you know, for the longest time lately, there's been this big writer's strike. So they have not been putting in that much money into their content, which actually makes things very difficult to evaluate Warner Brothers Discovery now. And that's just kind of the whole story about them, and where I'll just kind of like leave it for you to figure out if you think the value is going to be there or not, since this is basically projections you're making, and the market right now is not thinking too positively on it. Since if you assign them this $5 billion of free cash flows EPS at $25 billion market cap, that would be a 5P ratio. So I'm just also going to pop over to interactive charts here so we can look at some of these analyst estimates here, because you can see the revenue with estimate. There's no way to do a relative analysis, it's all new, and you can see basically they're expected their revenue to increase a little bit, but this is barely with inflation, and this might be optimistic. If there's more write-offs or things don't go well because of these streaming wars and they're losing market share and everything, it could be really bad. And also when we bring up the EPS with estimate, you can see that even going a couple of years in the future into 2025, they're expecting to be about flat on the EPS. So even though it looks like they have basically a lot of free cash flow, let's just go back into the financials here, and you would think that at some point it's going to kind of balance out what they're depreciating and basically what they're re-putting back into the company, because in the long term you would expect basically your free cash flow and your EPS for a stable company to eventually just normalize and be about equal. But if the market or analysts are basically expecting that there's going to be no EPS even 2 years in the future, what are they actually expecting? Are they really expecting that Warner Brothers Discovery is going to be making as much money off their basically content, are going to be doing more impairment in the future? And even though they may be doing more impairment for the next few years, they may actually still be able to be paying down debt in the meantime, setting themselves up for the future. So right now, Warner Brothers Discovery, you can just look at the chart. This isn't looking so good. What's going to happen? I would guess it's probably going to base for a while. It could even go lower. They have a lot of headwinds for them, and a lot of it, even though the free cash flow on a free cash flow basis, it looks really positive. Well, once basically they start spending for new content and try to regain market share, that could basically change very quickly. And in this competitive land space, especially when you have these no growth companies, as we basically saw from the analyst estimates, sometimes a lot of times no growth means you have declining margins, and then you're eventually going to go negative. So potentially there is a little bit of value in Warner Brothers Discovery. I wouldn't say they're going to be going bankrupt right away, or there's not really any signs of that because their free cash flow is really good. But from what we're seeing from analyst estimates and just the overall landscape, and just from the short term that our financials are thrown off from the writer's strike and this merger, there's a lot of things to kind of be cautious about in it. It could be potentially a really good value if they really turn things around and do things, but I personally am just kind of waiting, watching, see them pay down that debt a little bit more, and then see when they basically start to post better EPS. Because even though the cash flow is going well, the market really cares about EPS. I've invested in other stocks, such as some of the tobacco stocks like BTI and Alteria Group, and even though basically the companies are making more money because they're doing these impairment charges and write-offs, the market keeps punishing for it, and the stocks are just going sideways and not going up, even though I'm collecting that dividend. And what I don't like about Warner Brothers Discovery is I don't have any of that safety of collecting the dividend in the meantime. Right now, you're basically just getting diluted basically very slowly from the whereas it's a stock-based compensation here, and you're just hoping they're able to pay down their debt and their business is going to turn around in the future. But free cash flow front, maybe trading at a 5 PE of free cash flow, so could be good, but that's not necessarily going to be the case going forward. So I hope this gave you some insights, a little bit more confusing stock and a lot more unknowns going in the future. But make sure to like the video, subscribe to my channel, and I'll see you in the next stock analysis.